I'm Philip Clark, Farmers Weekly's Economics and World Editor, and I'm here to talk about the recession. There is a view in some circles that farming actually does rather well out of a recession. As the graph shows, and check out the yellow bars in particular, that was certainly the case in the mid-1970s, when farm incomes jumped in the aftermath of the world oil crisis. And again, in the early 1990s, as interest rates soared, the housing market collapsed and sterling was forced out of the ERM, farm incomes bounced again. But what about now? What will happen this time round? Well, as any economist will tell you, there are two sides to every coin. On the downside, the food and farming sector will inevitably be affected as unemployment rises and consumer spending falls. Already there is evidence that consumers are trading down, looking for cheaper cuts of meat, more basic dairy products, less cream cakes. This is making higher value food products harder to shift. There are also signs that some shoppers are turning away from the main supermarkets and heading towards the discount stores such as Lidl and Netto. This will increase competition among all retailers, which in turn will put more pressure on their suppliers, including farmers. The cost and availability of credit is another major concern. Even though the Bank of England has cut base rates substantially in recent months and is poised to cut them again, it's the interbank lending rate that really matters, and this hasn't moved down in tandem. As a result, the premiums banks are charging above base rates have increased, and with agricultural borrowing at record levels, the cost of servicing debt is putting real strain on some farm businesses. There are also problems with accessing new lines of credit. While farming is still a relatively safe bet given the value of land, the credit crunch is biting so hard that many lenders are extremely nervous about making new loans. This is making it difficult for farmers to raise funds for new investments, especially if it involves diversifying away from pure farming. But there is a flip side to the recession coin, and it's fair to say that agriculture will not be the worst affected sector of the economy, and the reason for that is almost entirely down to currency. Historically, there's a strong link between farm incomes and the prevailing exchange rate. As the pound goes down, so farm incomes go up, as exports become more competitive and imports more expensive. With organisations such as the OECD saying that the UK will suffer a deeper and longer recession than other countries, and with UK interest rates lower than those in the Eurozone, sterling has slumped to an all-time low. A commensurate rise in farm incomes is surely to be expected. But what of commodity markets? Global dairy and grain prices have clearly been under pressure for some time, and for cereals in particular, farmgate prices are well below year-ago levels. Many analysts believe this is just a short-term blip and the supply of some commodities is already starting to contract. For example, wheat plantings are significantly down this winter, while global beef production is also expected to stay tight. Demand for agricultural commodities should also remain quite strong next year in key markets like China and India. These economies may have seen some slowing down this year, but they're still growing at around 5%. As incomes increase, so does the demand for a Western-style diet, which is good news for meat and dairy markets. Analysts are therefore predicting a good recovery in world commodity markets during the course of 2009. So where does that leave UK farmers? Based on past experience, there are reasons to be quite optimistic for agriculture in time of economic recession. But with high input costs continuing into 2009 and the credit crunch still hitting hard, any gains in farm incomes are likely to be quite muted.